Hello, everybody. Welcome to my Introduction to Accounting Part 13. We're going to look at a bigger example because we like to look at problems. This is going to be the best way for us to go through and to learn accounting. We're going to go ahead and record transactions into the t-account. So what are we going to do today? We're going to be doing this over a series of videos because the first thing we're going to do is we're going to record the transactions into the t-accounts. We're going to make a trial balance with revenues, expenses, and dividends. We're going to then prepare an income statement, a statement of retained earnings. We're going to close out our temporary accounts to retain earnings. We're going to prepare a post-closing trial balance, and then we're going to do a balance sheet, but there's no way we're going to do this in one video because I'm trying to keep these short. Let's go to it. So right over here, I've got YYZ was created. Beginning retained earnings was 0. YYZ had the following transactions during the year. So we're going to record the transactions. So we're going to have assets are equal to our liabilities plus our owner's equity. We got debit, we got credits, we've got revenues, expenses. Oh boy, almost flipped it. Almost had to go there. Revenues. Right. So again, assets are going to be typically have a debit balance recorded with debits. Typically we'll have a debit balance increase with debits, decrease with credits. Liabilities and owner's equity typically have credit balances. They are increased with credits, decreased with debits. We record expenses with debits, revenues with credits. Let's go to it. On January 1st, Lifeson and PERT each contributed $80,000 cash for the common stock of YYZ. So the company is receiving cash. They're getting $80,000 from Lifeson, and then they're going to be getting $80,000 from PERT for a total of $160,000. So if I'm getting cash is an asset, this is going to be increasing by $160,000. Over here, I'm going to be crediting common stock, right? I'm giving them common stock. Common stock is a part of owner's equity. So right over here, I'm going to credit common stock, right? Does that make sense? Common stock is a part of owner's equity. So I'm going to show that credit over here. I performed services on October 1st, and I received $250,000 cash. Easy part first. I'm going to go ahead and record cash for $250,000. Now, for every debit, I need a credit. Over here, what I'm going to have to go through and do is, because if I performed services, I need to go through and recognize the revenue. And I recognize a revenue with a credit. So I'm going to go ahead and record that revenue right over here with a credit. Notice that I'm making the little notations on the side over here. This is because if I mess up, I'll be able to figure out what I did wrong later. Let's take a look at letter C. I paid a consultant $30,000 for services the consultant performed for me. Right over here, I'm going to credit cash for $30,000. So I'm going to credit cash, and for every credit, I need a debit. If a consultant performs services for me, it's the inverse of me performing it for somebody else. So this is going to be consulting services or expense. So right over here, I'm going to debit the expense over here for $30,000. Let's take a look at letter D. On November 15th, Rutsy paid us $80,000 for future consulting services. I will perform the services in February 23. Now, I haven't performed them yet, but I'm getting the cash. So over here, I'm going to debit cash for $80,000. I do not credit revenue. I'm going to credit an account called unearned revenue, which is a liability, meaning that I have an obligation to go through and to record those services later. So to perform the services later. So I got this cash, which is an asset. I'm going to record that asset with a debit. Unearned revenue is a liability. I'm going to record that with a credit. Over here, December 1st, I paid a dividend of $13,000 to my shareholders. If I'm paying a dividend, my cash is going down. So I'm going to credit cash over here for the letter E. Now, when we learned from the prior module that a dividend is not a revenue or an expense or an asset or a liability or equity, it's how I give money back to my shareholders. So what I'm going to do over here is I'm going to debit dividends And this is going to be over here for $13,000. That's letter E. Let's take a look at letter F. I purchased equipment for $40,000. So I got equipment. How did I pay for it? I paid $10,000 cash as a down payment, and the remaining amount was put onto a note payable that will be due in March of 2023. So let's figure this out. I'm receiving equipment for $40,000. Okay. Equipment is an asset. I'm going to go ahead and put this on my books with a debit. But for every debit, I need a corresponding amount of credits. I credit over here 10,000 in cash because that's how much I basically paid for that equipment. But now I've got a problem. I have 40,000 of debits and I only have 10,000 of credits. So the remaining amount is how much? Well, if I bought the equipment for 40 grand and I paid 10,000, the amount I owe is going to be 30,000. So I'm going to be crediting over here notes payable, which is going to be a liability. So that's how we're going to go through and record this. Now, one thing I've just introduced is you can have multiple debits and multiple credits. It just depends upon how the transaction is structured. So anyways, I want to thank you for watching us put it all together here. Please leave questions below, and I appreciate your liking and subscribing to my channel and for these videos. Have a great one.